Hey, this is Tom with Short Option Success. I just want to come at you with another video. Today, I want to talk a little bit about what I think is probably one of the biggest pitfalls of this type of trading. Now, this type of trading has been very, very profitable for me in my life. I've been able to teach several hundred students how to do it. And it's profitable in their lives, but there's always a problem. There seems to be in the beginning where people always seem to make this one mistake. And I just want to kind of go over that with you real quick. Okay. So I'm going to drag in my famous or infamous whiteboard here. I get a lot of comments about how untechnical I am, and the fact that I still use a whiteboard. But that's me. I like to use a whiteboard. So let's talk about this a little bit. So you understand when you sell an option, it doesn't cost you money. If you buy an option, you have to pay for that option. If you buy a piece of real estate, you have to pay for that investment that you're making. Now, you do have to have money in your account, okay? But whenever you sell an option, the amazing part about this strategy is that money comes into your account. Okay, so if I sell, say I sell a $500 gold call option. When I put that trade on and it's filled, that $500 goes directly into my account. Okay, my account cash balance goes up by $500. Now, the exchange will hold some margin money back. There will be, the option still has a $500 value, so your net liquidity will reflect there. But at the same time, that's money that goes into your account when you sell an option. And the mistake that a lot of new traders make, it's almost like a drug. I mean, they put a trade on, $500 goes into their account. They put another trade on, $500 goes into their account. You can literally, with span margining, which is available on commodity options, you can literally put thousands and thousands and thousands of dollars into your account in one day. Well, what happens is that's all well and good, except for the fact when that option, that the price of gold, whatever your option that you're selling, based on wherever your strike price is, when that position winds up going against you to a certain degree. If we did a call option here, we sold it, and gold would go up in price, the value of this option would then go up in price, which is not what we want. When we sell an option, we put it on there, we want that price to slowly and steadily decay and actually get to zero, so that this money just stays in our account and we get to keep that. Okay, but people kind of get this almost frenzy when they see how easy it is to sell options and put that cash into your account, and then they get over leveraged. They have too many positions, and they get themselves in a little bit of trouble. So I wanted to go through a quick scenario just to show you how I do this, and how it helps to keep you out of trouble when the market does move against you. So let's just say that what we do is we sell. Well, let me give you two. I'll tell you what. I'll give you two examples. The first one is I'm going to sell 5 contracts, and they're worth $500 each. And so that gives me a total of $2,500 deposited into my account. Okay, if I was to do that. All right. Now, what happens from this point? Let's say that the price, let's say these are call options, and the price continues to go up. And then all of a sudden, the value of our contracts that we've sold instead of them being worth $500 a piece, so we have the price increases. Let's just say it goes up by about 20%. 20% of 500 means they're now worth $600 each. And they now have a value of $3,000. Well, in commodity option selling, that's a bad thing, because now they're worth more than what we received for them. So we're in the hole by $500 at this point. Our trade is down $500 because the value of these options is more than what we received for them. All right. So let's say the price continues to increase. Let's say it moves a little bit more, and it goes up, and all of a sudden these are worth $700 each now. All right, 700 times 5 is $3,500. That's what the value of those 5 contracts that we originally sold is worth. Now we're $1,000 in the hole. Okay, so we're not out of the trade yet, right? We get out of the trade if the price doubles from what we received, but we've got some pretty big red numbers on our platform that we're looking at. This is not a great, wonderful, comfortable place to be. All right, now, so keep that in mind. Now let me give you another scenario. Let's just say I sell 1 contract at $500. Okay, so what have I collected? I've collected $500. Okay, there's where I'm sitting. And let's say the same thing happens again. The price goes up. All right, now the value it goes up to $600 per contract. Well, back here, I already had 5 locked in at $500. So what I could do, if the price comes up about 20%, now it's worth $600, I could sell another one. Sell 1 at $600. Okay, and that puts $1,100 in my account total, right? 500 plus the 600. Now, they're both worth $600 at this point, so I'm still down $100. But I've put a little more money in my account. All right, let's say again, the price continues to go up, and now they're worth $700. Okay, again, I could sell 1. That's $700. And now I've got $1,800 in my account. Okay, the value, you got 3, so you got $2,100. So we're $300 behind on that trade right now. Which would you rather be, $300 behind or $1,000 behind? This gives me a lot more options, a lot more opportunity to do different things if the price moves against me. Where if I lock them all in at $500, yeah, I'm going to make some money there. Actually, let's just talk apples to apples. I should have done it this way. Let's just talk apples to apples. Let's just say I did 3 here. Let's just say I did 3, and we'll redo these numbers so we actually can compare apples to apples. So I did 3 at 500. I collected $1,500. Then the price goes up to 600. Okay, so $600 times 3 is 18. So I'm behind on this first. I still only have $1,500 collected, and they're worth 3 times 6, so they're worth 18. So I'm down $300. And then it goes up again. Now they're worth $700. I've still only collected $1,500, and they're worth $2,100. Now, 3 times 700 is 2,100 minus the 15, so now I'm down $600. So let's look at the difference between the two scenarios. I collected more in the beginning, right? I only collected 500 here, or here I collected 1,500. I sold 3 at 500. The price increases, goes about 20% against me. They're worth now $600. I've still only collected 1,500, but they're worth 1,800. I'm showing a loss right now of $300. Goes up a second time, they're worth 700 each. Still only collected the 1,500. I'm behind by 600. In this scenario, I only sold one, so I only put $500 in my account when I first put that trade on. But when the price increased to 600, I went ahead and I sold another one at 600. Now I've got $1,100 in my account. Still not quite as much, but I only have 2 options, not 3. Okay, so I'm down $100 on that. 600 times 2 is 12. I've collected 1,100. I'm down $100. Goes up one more time. I sell one at this higher price. One more at $700. So now I had 11, I've collected 700 more, I've collected $1,800, and I'm only down $300. So I have $300 more in my account, and I'm not down as far as I was here. Now this is a very small example, but I've had people that literally have come in, and it's so easy to place trades. They'll do 5 and 6 and 8 and 10 and 12 contracts right off the bat. And when this thing moves against them, you can imagine, just kind of extrapolate that out with more contracts. You can imagine the difference that it would be, where maybe down here, instead of doing 1 each time, maybe you do 2 each time or something like that. It's all based on your account size and what you can do and what else you have in your portfolio. But the point is, rather than jumping in and at a certain price, I'd rather come in slower, and then if and when, because if we're doing 90-day options, that's a long time for that market to go against you, go for you, go back and forth and that sort of thing. So I'm just watching this as it's going on, and I'm going to add probably some positions. Maybe I'm going to add some positions at different strike prices depending on what's happening. Remember, most of the time we'll sell a call on a price moving up day, and we'll sell a put on a price coming down day. Okay, we get that little bit better volatility spike in our premiums that we're collecting. That's for another day. The point is, you don't want to overtrade. You don't want to get too many positions too quickly before the market has time to kind of do what it's going to do. Okay, so just something to think about. I'm not going to belabor the point, but you take this concept and you work this through. This is kind of one of those small nuances that you pick up as you start to do this. But I believe you're much better off to do something like this bottom scenario here. You're not gonna put as much money in on day one, but in the long haul of having your position, is going to be safer. You're much less in a problem here, and you're going to wind up putting more money in your account. Okay. So again, got any questions? Put them in the notes below or the questions below. Please feel free to subscribe to the channel. We'd love to have you a part. If you're interested in being coached in the selling of of options on the commodities market, Short Option Success is probably the industry leader in teaching on this subject. So there should be a link in the description as well, and you can get more information. So we appreciate you. Have a great day. See you later.